Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. Our guest today is Mathieu Chabran. Mathieu is co-founder of Tikehau Capital, a global alternative asset manager with over $30 billion in assets under management. Previously, he worked in the real estate market team of Deutsche Bank in London. He began his career at Merrill Lynch, first in Paris with the principal investment team, then in London in the high-yield capital market department. He received his education from ESCP Europe. Mathieu, welcome on the show.
Thank you, Andreas, and thanks for having me.
You founded Tikehau in 2004, if I'm not mistaken, so that's quite a couple of years back. What made you go from, I guess, a pretty comfortable position at Deutsche Bank to founding your own asset manager for that?
Yeah, I mean, it's a great question to start, Andreas. I mean, I was first lucky, not to go on my own, but to be led and encouraged by my co-founding partner, Antoine Flammarion, who I met actually. I was a trainee at Merrill Lynch in the early days. And after working 4 or 5 years together, and he being maybe even more entrepreneurial than I was, he told me, I think it's time that we give it a shot on our own. We were working comfortably, as you said, in the city of London. We met at Merrill Lynch. I was then at Deutsche Bank. He was at Goldman Sachs in the special situation group. And like many entrepreneurs, there is never a good time. I remember my boss telling me it's either too early or it's too late. Too early because if you stay another few years, in the investment banking career, you'll get very comfortable, probably both financially and professionally. But it might also be a little bit too late because, when you start in a business, it has to be a startup and you have to be 21 years old. And looking backwards, Andreas, there is never a good time. It's about stars being aligned. And when we decided to go our own way in 2004, we certainly, we took a little bit of a chance, on this, but that was the right moment. We gathered some, like any entrepreneur, some friends and families, some love money, as one would say. And we started with 4 million euros. And I'm insisting on that because in the asset management industry, in the finance world, it's all about how many billions you manage. And we started with 4 million euros. And, looking backwards, some may have, thought that we were a little bit crazy because if you think about that, 4 million euros, 2% management fees, that was 80,000 euros of revenues. And starting with such constraint, like any entrepreneurs, and I'm sure you would appreciate that, it's all about being this discipline in running a business, in starting a business, in investing in a business. And that gives you no other choice but to succeed. And I'm sure we'll have the opportunity, to come back to that. But each time I look back on the early days of our venture, I think that was a great way to remain disciplined. I might draw a parallel with what's happening right now, in the market, in the tech world, in the startup world, where sometimes when you've got way too much money, you lose a little bit the focus of what an entrepreneur should be, having a great idea, executing the ideas, and making, this project profitable for the shareholders. So, many things I'm saying here, Andreas, I'm sure we can come back to that, but that's what drove, this step forward, which looking back was a step with no way back.
I like that. We have, I think, a lot of things that we can start with. What I'm interested in today, you have a huge team covering many different sections, but what was your first fund about? What area, what niche did you focus on with those 4 million that you raised?
When you have 4 million to invest and that you have the ambition to tackle real estate, which is what, Antoine and I started in Merrill Lynch in the late 90s, that you want to tackle, credit. And at the time, no one even talked of private credit in Europe because I was a leverage finance, banker. When you want to be, special seat and you're like, all of a sudden, well, I've got all this ambition, but I've got reduced or constrained resources. So when you're in this situation, what you need friends with a deeper pockets than yours. And that's what we did, from the very outset. The first deal we made was, and which remained iconic to that day, was buying the flea market in Paris. For those of you who are familiar with that and who like antiques, it's one of these flea markets on the outskirts of Paris, similar to Portobello Road, in London. And so we acquired this real estate piece, if you will, but pretty particular. It was an 18 million transaction. We couldn't go all in with our 4 million, so we put half of our equity there, and then we started doing another round of co-investor, we would call it today, but it was very much, again, friends and family for us. We brought in our first institutional. Believe it or not, Goldman Sachs was the very first institutional to co-invest with us on such a small deal, I would say. And then obviously we put some debt and we get some financing in place. You have to do the deals twice, because once you have to be convinced for yourself and the small money you manage, but you also have to make the deal, for the people you're inviting to join you, because they're not just an LP in a fund, as someone would say today. It's very much like a club deal. And so you're living and breathing this exposure, for the next few years. Luckily, we were right on this investment. We financed very quickly. And in a matter of 2-3 years, we were approached by a very large London-based REIT who made us an offer to acquire this asset at a price that today it remained one of our highest return, which is fairly ironic looking backwards. As you say, today we're managing 35 billion euros, but it's this very small first investment certainly defined your investment style. And as far as we are concerned, probably an investment style which is very contrarian. All our co-investors from the very first deal, including Goldman Sachs, by the way, I think remain extremely pleased about the return. And since you're as good as your last deal, people wanted to do more. You send back the money and they say, well, we liked investing with you, show us more things. And then you start creating a fairly virtuous cycle, and off we go.
That reminds me a lot of what a previous guest, Howard Marks, says on the podcast, and his style of investing into debt assets was also A, contrarian, and B, he was looking for a niche, right? In public equities, there's not much value you can add by thorough analysis or anything the like. I wonder, how would a contrarian investment style in real estate look like? Do you look for buildings that are out of favor, or do you try to invest in markets while there's a downturn and everybody's trying to get out of real estate? Or how would a contrarian investment style in real estate look like?
It's a little bit what I described here, assets that people know have value but don't really know how to externalize this value. What we like to say is we like prime assets in secondary location, where effectively you can reconvert, upgrade, transform assets and take a view on how you can maximize the value there. Buying today, or a few months ago, given what's happening right now, but buying a prime asset, let's say on the Champs-Élysées in Paris, difficult to maximize the value. On the contrary, we acquired an asset which had to be repositioned on Pall Mall in London. It remained great location, but the asset had to be worked out. We can externalize value. That's commercial real estate. Residential, we just acquired 3,500 flats in Portugal. We worked with banks and we took, a real top-down macro view on residential in Portugal. Here in the US, where I sit, we worked with some partners to buy some warehouse assets in Connecticut, convert them into logistics. It's a mile outside New York State. Needless to give you the pitch about the logistics and the last miles and all these things. So, it's really about trying to bring this value wherever you can by taking a view. Obviously, you need to secure your entry price. You have to make sure that the reconversion cost, the length, and all the more in this market environment where we all know that supply chain and costs are increasing. When you get it right, that's when you call it fundamental value creation.
Interesting. And what are the areas that you cover as a firm today?
So Tikehau today very active across four main strategies. Those are our verticals, and you will see that in any of them, we always launch new adjacencies that will fuel the growth of this vertical. The first one, historically, as we mentioned, is real assets. So it's both real estate and now infrastructure that we expanded into here in the US. We're managing 12 billion across this strategy. Our second pillar, which has been at the core of our development, first in Europe and now here in the US, is private credit. We were born right before the GFC. We took off on the back of the GFC, and private credit, direct lending, bespoke solution has become in Europe a real opportunity. Likewise, we're managing today 12 billion across these strategies, special ops, secondary private credit. We pioneered this strategy here in the US that we launched 18 months ago. It's a great area of growth. We can come back to that, or the more in current cycle. Third pillar is private equity. But at Tikehau, we have always approached private equity, private capital in a fairly different manner. We don't do controlled buyout. We're not a control investor who's looking, to maximize price by maximizing leverage. And let's see where this unfolds in the current environment. But we've always been a partner to entrepreneurs. So providing long-term, flexible, patient capital to entrepreneurs, to families who they don't want to sell their company. They're not trying to maximize price and exiting their company. They're looking at strengthening their balance sheet. They're looking at bringing a partner because they're growing, because it's capital intensive, because they're looking at an acquisition, because they're looking at expanding. And so this strategy, which is the most recent one at Tikehau, but nonetheless the fastest growing, is proving to be extremely relevant in the current market, because not only we're tackling some mega trends, energy transition, can come back to that, aerospace, defense, cybersecurity, regenerative agriculture that we announced a few weeks ago. So really trying to take some mega trends, make a difference in the way we approach and partner with entrepreneurs and scale their business, massify their business. The fourth business line is capital market strategies. So it's more a security business around public equities, public bonds, but still applying the same fundamental top-down analysis to every investment we make. And all that creates a very dedicated teams within an integrated platform where we try to maximize the collective intelligence at any point in time that we can generate so that any of the partners of our colleagues can benefit at any point in time. Our setup today is global. While we were primarily a European firm, we've got a local presence now in all the key Western jurisdiction. We were born in Paris as a firm, but very quickly expanded in London, obviously, in Brussels, where we had a great footprint, private investors, and then, Milan, Madrid, Amsterdam, Luxembourg. We opened Germany, Andreas, last year, which was a critical market that we were not addressing in Europe. And then expanding it internationally. Asia was our first expansion far away from our domestic markets. First in Singapore, a massive hub for us, the benefit of the support of Temasek, Singapore Sovereign Wealth Fund, a great partner, great investor since they joined us. Then expanded into Korea, here again, a great market to address the corporate pension plan. Open Tokyo. And only in 2018, we moved to North America. I relocated to New York. It was critical that one of the senior partners, moved there to effectively help build the team, convey the message, promote, the brand. In a matter of, 2-3 years, we were 50 people here, very active on the fundraising, but also on the deployment. And now we're adding, new places. Tel Aviv, Israel is the last opening, we announced a couple of months ago, and there's still, a few to come. So it's a business really built across these verticals. We develop some local intelligence, and we really want the firm, to work as one. I think we've been fairly successful at doing so. That's part of our job, daily job, to make sure that partners and colleagues work all together, as one.
I was like, in 2018, you opened in the US. That is very shortly before the pandemic. How did it go? How did it affect how you started rolling up the US business? I mean, for European, I know that from the startup side, for European startups, it's really, really hard to catch a footing in the US general for European companies. I can only imagine it must be double difficult during the global pandemic.
It was very much 18 months before that started. So effectively, the first move here was September 18, blank page, an empty floor, sitting here in offices in the meatpacking district. And like we've been doing everywhere else, European offices, in Asia, it's about, building the footprint so that hopefully the first impression lasts and the first partners you work with, the first clients you work with will be, key differentiator in your expansion. So one of the key projects I had when we arrived here in the US was to replicate what we had been doing in Singapore, with Temasek, as I was referring earlier, and finding a local partner who could help us navigate the North American market, be a key reference for us. Again, we're not selling the company, quite the contrary, we were expanding. And so we started having many discussions with potential partners and ended up having Morgan Stanley becoming a shareholder of ours on similar terms as Temasek, minority partners, but very active partners to help us on investment sourcing, distribution, navigating, the LP market. So that was, the first step. The second step was to convert our investor base. In September 18 here in the US, we had a very limited LP discussion. As a matter of fact, we had one Canadian LP for $50 million out of a 20 billion AUM base, so very marginal, because we had never spent any time addressing this market, which, as you know, is the largest and deepest market, in the world. So we started doing that. And if you fast forward, 3 years later, and out of a 35 billion AUM base, it's now, close to 3 billion coming from North America. So it's been progressing. It's very encouraging, still in the early days, but we're on the very right track to get to where we should be, which is looking at my competitors and nonetheless friends, something like 35% of your AUM coming from North America. So that was the second objective, well on track. The third objective was to start deploying some capital here in the US. But as we like to say at Tikehau, Andreas, it's about create, not compete. Because in our world, obviously, a big franchise here in the US, they've always been leading the pack. And if I want to differentiate myself, if I want investors to invest with Tikehau in complement to their allocation to the big US franchise, you have to bring them something differentiating. And that's what we did. We brought secondary private credit, as I was mentioning, as one of the pioneers, here. We brought some mid-market private equity solution way before it became such a topical and rightly so investment strategy. So, it's a journey, it's a process. That's how we started. Doing that during the pandemic, coming back, to your point, was an interesting challenge, but a great opportunity. Let me explain that. When New York went into lockdown for the reasons, we all know, very quickly when it reopened, we told all our colleagues, all our partners, our employees, the office is open and we will be there. And we didn't force anyone to come back, but because we were in a fast-growing mode, all of my colleagues came back, as early as Labor Day 2020. Very early compared to what was happening, in Manhattan. And that created a very positive dynamic because as we were growing, we were interacting. We were having, all the chit chat, these small talks, the thing that create and make all the difference when you're in a fast growing environment for a company like ours. Now, obviously some challenges when trying to reach new investors, new partners, and you only meet them over Zoom. And as much as you can have a very warm discussion, if you don't have the time to really meet in 3 dimensions, it might be, sufficient, but not enough, to create this relationship. So that was part of the challenge, clearly. But as I said, the opportunity was to have the team growing and taking that to the next phase. All the pipeline we had raised pre-pandemic, we've been able, to convert during the lockdown, or when people were effectively not 100% on the pitch. So it gave us this opportunity to level up our presence, in North America, and then capitalize on that as we got out of this situation. But, one thing I will tell you, Andreas, and a huge tribute to the whole Tikehau Capital staff and crew and partners and colleagues, is the engagement, the discipline, the commitment that they all had during this period, was a great pride for us all, because despite all the many headwinds and challenges, thanks to their commitment, we really transformed Tikehau from 2020 today. We almost doubled our AUM base in very adverse market conditions. We maintained a very disciplined investment approach, underwriting criteria. We increased the footprint, as I was mentioning, geographically in opening a new presence. And it could have been easy for us, to step back and wait for better days. But the reality is that, you make the difference effectively when people are stepping aside, and that you decide to gear up. And that's what we managed to do, once again, thanks to the commitment of the teams.
You said that you managed to raise all the capital that you had in the pipeline. Did COVID impact your ability to deploy the capital, or did it change your, I'll say, global investment style or your global strategy a bit?
So let me start by also explaining, the structure of Tikehau. We're one of those asset managers operating with very significant equity base. We're publicly traded, on Euronext. We've been listed, for the past 5 years now. And this equity base, this capital, the firm is majority owned and controlled by the founders, the team, the staff. And so we have this very unique feature to still be a founder-led and a management-owned firm, committing very significant capital into any strategies we launch. And why am I saying that? Is because when you have a very significant skin in the game, when you have a second to none alignment of interest, when those circumstances that you are referring to, COVID, these, uncharted territories, then the team become, your best risk manager, because they're all in side by side, with the LPs, with the clients, with the investors. And not to say that others, wouldn't be as disciplined, but it creates this little je ne sais quoi where people are effectively, taking their commitment to the next phase, because first and foremost, it's their money at stake. And so this structural feature has been critical in navigating COVID. And again, all credit to the teams, because then they were as reactive as the entrepreneurs that they were financing or invested with, on the other side. We became, very active and very reactive stakeholders. We were not just a lender, or not just, a co-investors, or not just, a landlord. We were partners to situation, because we living the same experience that the entrepreneurs we were partnering with were living on the other side of the table. So what has changed in terms of investment opportunities? Again, if you look at our across our strategies, I will start with the capital market strategies. Obviously, a massive market downturn, a massive central bank intervention, both in Europe, in the US, and obviously our portfolio managers or colleagues have been reacting and adapting, adjusting their portfolio very quickly and taking advantage of great credit opportunities. On the private credit side, obviously many banks, many states, led some state guaranteed initiative where we provided some capital to companies. So for us, it was all about making sure that our companies were not getting into some liquidity shortfall, some liquidity squeeze, and being very bespoke. And that's where asset manager like us, I think, have taken a lot of credit globally. Certainly goes beyond our own positioning in being flexible, nimble, bespoke partners. And when you're working with entrepreneurs on the other side, that's what they're expecting. They just don't want a bank is, with all due respect, they're providing some funding. There is a loan, there is a contract, there are some covenants. What we wanted to do was to show that we could act in a partnership way. On the equity side, Andreas, as I was mentioning, we're not controlled buyer. We are minority growth equity expansion capital partners. And that's where this overall situation, this COVID situation, provided incredible opportunities, because those family-owned business, those entrepreneurs, they realized that they could make a difference if they were operating with a solid equity base, not only relying on financing, because these circumstances created some stress on their P&L. And so it was a great time to strengthen European SMEs balance sheet, European mid-cap entrepreneurs across this vertical I was referring to. So the whole toolbox, if you will, the whole Tikehau toolbox became a very relevant tool to deploy, across these strategies. Now, that was COVID. It sounds like history. We've entered a new cycle, combination of the inflation, of the interest rates, obviously the macro and the geopolitical situation in Russia and Ukraine. And so there's no time to step back and relax, if I may say. I mean, the team is constantly on the pitch, with the same companies that we been invested in for these past few years. But I'm convinced that these headwinds, this new normal, this new investment environment is going to create all the conditions for asset managers to be discriminating, to have, demonstrate their ability to generate performance and not just be pushed by the accommodating monetary policy that we've been living through over the past 10 years. So, my point here, Andreas, is as painful these past 2-3 years have been and remain, as painful this new interest rates, credit market environment, can seem, to many. I think we're coming back to a more normalized environment for investors, for asset allocators, for asset pickers. And I'm convinced that Tikehau can thrive in this environment, because then you can be differentiating.
What are current trends or strategies that you focus on in this environment, or that you focused on in the last couple of years?
I would say it's in a family, right? You don't have any preferred child. So we're focusing on all of them, at once, but we adjust and adapt. Right now, for example, in private credit, clearly the new cycle that we are entering in will require very bespoke capital. Call it special opportunities, tactical opportunities. It's about being able to react and provide the bespoke financing that companies might need in this environment, where both the P&L and the balance sheet could be hit. The P&L because of the, let's say, global slowdown, increased rating cost, inflation, increased interest rates, and so cost of funding, for the balance sheet. And that's where we can be very reactive. On the real assets, it's about creating, both on the real estate through the leases and on the infrastructure through the concessions or contract, some very long-term inflation hedged fixed income revenue stream. Great opportunity, once again, where investors are looking at deploying capital that will be hedged against this inflation. On the private equity side, I mentioned, those mega trends. We're coming out of a few years of dramatic changes, both globally. Climate change has become a top priority for any governments, for any stakeholders, and asset managers have a key role to play. But also because of what's happening geopolitically, you see that it's all about deglobalization. So many of your providers, suppliers that were China, elsewhere, you can no longer depend there. So all the entrepreneurs, all the companies, they're trying to have shorter, closer suppliers. Great opportunity. And here it's across, as I said, those mega trends. I was talking about energy, obviously, a lot of talks around that. It's about food dependency. It's about industrial. I can think of, aerospace, typically, where, we're very active. Last but not least, cybersecurity. We see that one of the biggest challenge nowadays. I liked what one of the top Wall Street boss, Jane Fraser, running CEOs of Citi, once said, a few weeks ago. Now in the ESG, which has become the norm for any asset manager, in the S, it's obviously social, but it's also security, and it's security across the board. It's security about energy. It's security about food supply. It's security about, as I said, cyber, which is becoming, great threat. And so all those mega trends, once again, are one that we are trying to tackle, one that we are heavily invested in, creating, the environment for us to be extremely optimistic about, what we have ahead of us. And if there is one silver lining to this overall situation that has been dramatic, in many ways, is that, there will always be great areas to deploy capital, to invest, as I said, side by side with your clients. And so the whole toolbox, as I said, can really find a home in those circumstances for us.
Very interesting. I just thought about how this investment approach that you described with patient private equity differs so much from the private equity that is in the media portrayed with like the barbarians at the gate style private equity, that here you focus on a core topic. And correct me if I'm wrong, but it sounds like you investing your own balance sheet into the funds you create also makes it just, you have this extra level of like, is this what I want to support? Is this where the future goes, right? Because you cannot only look at the market for guidance on what is the next big thing. You have to think about it yourself because it's your own money on the line if you invest in, for example, decarbonization or ESG focused.
Right on spot, Andreas. That's exactly what I was trying to highlight and express. And that's why, with no disrespect to any other managers, but that's why I think you never saw and you will never see Tikehau following the trends or following the herd. You did not find us in the digital, crypto, NFTs. Maybe some people have a great expertise there, but we didn't have the conviction to put our own capital there. So we would not just be opportunistic to say, okay, why don't we raise crypto fund and we're going to raise some capital and take some fees there. We didn't have the conviction. That's why you did not see us. And as a matter of fact, we've been very public and vocal about some of the tech valuation, both private and public, over the past 3 years. Here again, many have been trying to push us into the tech growth equity that we are today very much prepared to address and look into, because we're coming back to valuation that financially makes sense. And we've got fiduciary duty vis-a-vis our investors, our LP, but to your point, first and foremost, vis-a-vis the partnership. And so certainly, it creates this situation. It might be implicit, but very much differentiating. And I can tell you that if you were to attend, some of our investment committee or capital allocation committee, you would see that there is a real confrontation, but in a good way, because all partners are sitting all together, bound by the same investments they're making side by side, be them in Asia or in the US, in real estate or private equity, and we're trying to create effectively this approach where there is no consensus. So yes, I think it makes a difference. I actually think that, if you allow me to be a little bit provocative, when people talk about ESG and the governance and all that, I actually think the first critical point would be for managers to have more of their own capital invested side by side their clients. Because the industry, the private equity industry, they've been relying on some concept of alignment of interest, which in my view are a little bit light, like a carried interest. We're aligned because, I put 1% of the fund through the GP, but I can make a lot of money if it performs. Fine. But what happens if it does not perform? What do you effectively have, on the line, as holding you up? So I actually think that as a matter of respect, duty, commitment, having significant balance sheet capital invested in any strategy you manage and where you bring third-party investors should be a must-have and no longer a nice-to-have.
It's a big decision factor for asset allocators to decide which hedge fund, for example, they're going to. If the manager or the team has a significant portion of their own wealth in the fund, they actually have a lot, I guess it's the same for you. You have a lot more to lose from losing your capital base, your own money that's in the fund, than you have to gain from the fees that you might create. So this is a very nice level. But I want to jump a bit to another topic before we wrap up for today. And this is, you have been there at the start of the company. You founded this company. Now it's a public company with 35 billion AUM. How did your job throughout time change?
Yes, well, it has changed dramatically. It was a two-man show, Antoine and I, with certainly a lot of ambition to build something, but with limited resources. So as I was saying, at the beginning of our discussion, you had to bring partners, you have to convince people, you have no brand, you have no track record. The only thing you can put forward is your commitment. And we started by being all in, to our earlier point about the alignment of interest. And then, bringing alongside you some building a team of people. And when I look backwards, we just celebrated a couple of weeks ago, many 15 years anniversaries of some of our colleagues and partners who joined us in the very early days, when Tikehau was barely 20 million AUM, with a limited presence in Paris. And, they bought into the story, they've been a driving force to the expansion. And today they are, head of businesses, they are head of regions in Asia, in the US, in Europe. So our job as an entrepreneur is to be constantly on the move in the expansion, in good times and bad times. It's to be on the move on the investment and the allocation of capital, and always be, supportive on the decision that your team, is helping you making. And as you go from a 2-people team to 750 people team, a small office operation to a global 13 offices operation, it's about making sure that the culture remains. And that, Andreas, as a entrepreneur and the people listening to us, other entrepreneurs, I'm sure you will share that view, is you should never lose what is making you different as a firm. Why are people joining you? Why are the people who joined us 15 years ago are still here with us? And I'm sure, we'll be there for the next 50 years, about this culture. And that's probably the most challenging part, because it's an intangible. You've got today, different culture. I mean, we've got 37 nationalities today across these 3 continents, 13 offices. We're still, a month ago, Andreas, we gathered the whole firm all at the same place, the French Alps, for 3 days, first time since COVID. We had a blast, but in a good way, because, it's about, it's like a sports team, right? You cannot get on the pitch on a Zoom, right? It's you have to be in the locker room together, and you have to go on the pitch and have this vision. And so that's the first one, the culture. The second thing, obviously, because our job is to manage money, is to manage financial risks, is to make sure that the discipline that Antoine and I had in very early days, we want that to remain across funds, across strategies, and never becoming complacent. You never want to become complacent, or you never want to downgrade or reduce your underwriting criteria. Our job is to hopefully show the direction, but also help our team every day to go from the 10,000 feet view, the macro view, what's happening in the world, to, they've been working on a deal for 3 months. And yes, they want to get this deal through completion, because obviously they've been carrying, this deal. So that's how we have changed. Now that we can travel again, our job is very much to travel around, spend time with our colleagues. I mean, last week, my partner Antoine, spent the full week in Seoul, Korea, where we were celebrating, our 5th anniversary down there. Great job from our colleagues. I'll be traveling again, this summer across our European offices. So the job is evolving clearly, but I would say we are also evolving with the job, meaning that if we have to go down into a deal with the deal team, we will do it. We will be their partner. But by the same token, it's also about trying to look beyond the next, 3 weeks. I don't know what's going to happen on the market in the next 3 weeks, but we're not here to time the market. We're here to effectively, over the next 3 months, over the next 3 years, over the next 3 decades, Tikehau keep building with the same, again, culture and discipline that will make us successful and a great place for our people to work.
What are some of the prerequisites that you would expect from your team, your people, your management team? You might relate it to yourself or to your management team or to your new employees. What are some of the developmental prerequisites? Because a lot of our listeners are young professionals, right? They want to grow in their career. What distinguishes an employee comes from this, like being the first investment manager to being the, head of a department or something, from an employee that starts at the company early and then probably leaves or just doesn't grow that much?
Well, I mean, listening to your question, I can see so many faces of my colleagues or partners who've gone through the journey. I would say it's very simple. It's first making the assumption that all the people working with us are smart, are qualified, they tick all the box from a technical standpoint. But then what are the social skills, they need to effectively make a difference? The first one is to be curious all the time, not just to be sitting in front of your screen and do, your only little routine. Partly, when you have the chance to have so many different people, strategies, around you. And the second thing, Andreas, and that's one quality which is becoming more and more challenging, is to constantly get out of your comfort zone. There's nothing like becoming comfortable, because when you become comfortable, you can become complacent. And that's what I was referring to. And so the most successful people in our firm historically, and certainly for the years to come, are young people who raised their hand at the age of 28 or 30 and told us, I want to move to this country. I want to change in a department. You know what? I mean, the 6 or 7 people who came with me in September 18 to open the New York office, were junior people who had been with us for a few years. They were working in London. They were working in Paris. We have some Italian, some Brits, some French, some Belgium. They came along with me. They got out of their comfort zone because you arrived here. It's a blank page. We don't really know what the roadmap is, but the way they capitalize on their own career to start with, but also as a valuable partner to the firm, is immense. It's incredible. Best people today are people who, in a matter of 10 years, worked out of the London office, the Singapore office, the Paris office, people who've been working in different business units. More importantly for them, I think it creates the conditions that waking up in the morning, getting to the office is not a pain. It's actually a real opportunity. And every day I've got some people reaching out to us. That's the other thing we try to do with Antoine, is to remain extremely open and accessible, to anyone, even the most junior people, to listen to their ideas, to listen to their comments, sometimes, to their critics, to help the firm, grow. So this would be my 2 key advice, is to be curious and constantly get out of your comfort zone.
Perfect. Mathieu, thank you so much for coming on the show. I think with those 2 very good pieces of advice, we will end this here. Thank you so much, and all the best for your further growth with your amazing team.
Thank you, Andreas. Thank you.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Hey again, this is Andy. I hope you enjoyed the episode. If you did, please leave us a 5-star review on Apple Podcasts or wherever you get your podcasts from. Share the episode with your friends, with your colleagues, and everybody that is interested. And if you want to reach out, feel free to drop us an email, a message on social media. And I look forward to hearing your thoughts, your comments, your feedback. And thanks again for listening. Have a great day.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.